All right, so let's get right into it. We're heading towards the end of the year, and you guys have sent in some really interesting articles on portfolio management.
Mm-hmm.
And this particular one, 3 fundamental portfolio moves stock market investors should make before the end of the year. We're going to be kind of diving into that today.
Okay.
Hopefully, as we get towards the end of 2024, we can make some smart money moves and
set ourselves up
for success next year.
Absolutely.
So one of the things that I found really interesting in this article is it really emphasizes, kind of understanding what you own and why you own it.
Right.
And I think it's something that, maybe gets overlooked sometimes when you're just kind of chasing, a hot stock or something like that.
It's easy to kind of get lost, in the weeds.
Yeah.
And forget about the fundamentals. And I think that having a really well-defined investment thesis is critical.
Yeah.
For every investment that you make, you want to make sure that you have a roadmap.
Yeah.
Why are you buying this particular stock?
And they have a really good example in here with Microsoft. They were talking about, kind of the key points with Microsoft. They have really diverse revenue streams.
Yeah, they're really well diversified across multiple different sectors.
Strong cash flow,
Mm-hmm.
And then potential for AI-driven growth.
Huge potential there.
Which, of course, everybody's, talking about AI.
Big buzzword these days, right?
Yeah. Yeah. But then they also mentioned that, the high PE ratio.
Right.
So what does that mean, for somebody who is considering Microsoft right now, when they see that PE ratio?
Well, so the PE ratio is a measure of how much investors are willing to pay for each dollar of earnings.
Okay.
And so a high PE ratio often indicates that the market expects significant growth from the company in the future.
Okay.
So it can be a signal of optimism, but it can also be a sign that the stock is overvalued, meaning that its price is inflated compared to its current earnings.
So how do you know, whether that high PE ratio is justified or not justified?
Well, that's where the real analysis comes in. You have to dig deeper into the company's financials, look at industry trends,
Right.
Consider factors like competition and potential risks. And you might find that, some companies with high PEs are indeed poised for significant growth,
Mm-hmm.
while others may be riding a wave of hype that is not sustainable.
Yeah.
So it's all about, understanding the story behind the numbers.
That makes sense. I think a lot of times, too, it can be confusing. You see all this information, you're like, oh, well, it's, the PE ratio is high, but it's going up. But is that going to continue?
It's hard to know.
And I think that's something that sometimes is difficult, when you're trying to look at all this information and be like, okay, what does this all mean?
And it's really easy to get caught up in the short-term fluctuations of the market.
Yeah.
But what we're really trying to do is identify those long-term trends.
Right.
And really understand the fundamentals of the business.
And one of the other things that they mention in this article is how your portfolio allocation, can shift without you even realizing it.
Yeah.
And they were using the example of NVIDIA and Meta platforms.
Okay.
Where, NVIDIA was up over 200% in a year, and Meta platforms is up over 90%. In a year.
Wow.
So how can changes like that, impact an investor's overall portfolio?
Well, imagine you started with an equal amount invested in both NVIDIA and Meta.
Okay.
After a year, the portion of your portfolio represented by NVIDIA would be significantly larger.
Just because it grew faster.
Simply because the stock price grew more rapidly. And suddenly you might find yourself overexposed to a single company, even if you didn't actively buy more shares.
So how do you address that then? Do you then sell off some of the stock that's done well?
It depends on your individual goals and your risk tolerance.
Mm-hmm.
Rebalancing your portfolio doesn't always mean selling.
Right.
You could also consider directing new capital towards other promising areas to bring your allocation back in line with your original plan. Think of it like tending a garden. You're making sure you have a healthy mix of different plants.
Yeah.
And you're pruning strategically to keep things in balance.
I like that analogy, because it does make it sound less intimidating. When you think of it that way, instead of oh my gosh, I gotta sell everything and buy all this other stuff.
Yeah. No, it doesn't have to be a drastic overhaul.
And then, kind of going back to that diversification, the article briefly mentions capital preservation versus accumulation.
Right.
So, how important is it to consider, where you are in life when you're making these investment decisions?
Absolutely. Your investment strategy should evolve as you move through different phases of life. Someone in their 20s or 30s
Okay.
who's primarily focused on building wealth for the long term,
Mm-hmm.
They might be more comfortable taking on a bit more risk.
Yeah, because they have more time.
They have time to recover from market downturns.
Right. Yeah.
So, they might lean more toward that accumulation side. And, they're looking for investments with the potential for high growth, even if it comes with higher volatility. But as you go closer to retirement, your focus might shift to preserving the wealth you've built.
Okay.
Right.
So then it becomes more about that capital preservation.
Exactly.
But what does that actually look like, in terms of what types of investments would you choose if you were going that route?
Well, you might start to favor investments that offer more stability and income, like bonds or dividend-paying stocks.
Okay.
It's about protecting your nest egg and ensuring you have a reliable stream of income during retirement.
So it sounds like it's kind of like finding that balance, as you get older, between risk and return becomes even more crucial.
Absolutely.
Because you want to keep growing your wealth,
right?
But you also want to protect what you've already built.
Exactly. And this is where working with a financial advisor can be incredibly helpful.
Okay.
They can help you assess your risk tolerance,
right?
Develop a personalized investment strategy, and make adjustments as your needs change over time.
So one of the things that I found really interesting in this article is that they talk about how saving consistently can be even more important than finding amazing investment returns.
Really?
Yeah. And so I was kind of surprised by that.
Yeah, I can see why that might seem counterintuitive.
Yeah.
But think about it this way. Even if you find a fantastic investment that doubles in value.
Okay.
If you've only invested a small amount, the overall impact on your wealth won't be that significant.
Okay.
But if you consistently save a substantial portion of your income, even if your investment returns are more modest, the cumulative effect over time can be remarkable.
So it's more about the long game.
Yeah, it's the power of compounding.
So it's not just about hitting that home run with the investment.
Right.
It's more about making sure that you're saving consistently.
It's about saving a priority, automating your contributions,
right,
and gradually increasing the amount you save as your income grows.
It kind of reminds me, too, about I was reading something recently about the psychology of saving and how, if you can frame it in a positive way, instead of thinking about it oh, I'm giving up this money,
right,
it's more about what am I gaining? What am I gaining in the long run?
Absolutely. Our mindset plays a huge role in our financial success.
Yeah.
If we view saving as a chore or a sacrifice, it's going to be much harder to stick with it.
Mm-hmm.
But if we view it as an investment in our future, it becomes a much more empowering and motivating habit.
So instead of saying I can't afford to save, you're saying I can't afford not to save.
Exactly. It's a shift in perspective that can make all the difference.
So we've talked about, reviewing your portfolio. We've talked about managing allocation. We've talked about, understanding the impact of your life stage on investing. And then, the power of saving consistently.
Right.
But I think, realistically, even if you have a solid plan in place, the market can be unpredictable. So what advice does the article offer for navigating that kind of market volatility?
Well,
and making sure that, your emotions don't lead to bad decisions?
Well, I think one of the biggest things is to remember that, market fluctuations are normal.
Yeah.
They're part of the investing journey.
Yeah.
It's going to happen. And I think instead of trying to, time the market or make those emotional decisions based on those short-term swings, have that long-term perspective.
Yeah. I think sometimes it's hard to, you see the numbers going down and you're like, oh, should I pull out now?
Right. It's really easy to get spooked.
Yeah.
When you see those headlines, and the market's tanking. And
exactly.
But the key is to, have a plan and stick to it.
Yeah. It's just riding out those waves, knowing that it's happened before, it's going to happen again. And
right. Historically, the market has always recovered from downturns.
Right.
And, having a diversified portfolio can help mitigate some of that risk.
Okay.
When one asset class is down, another might be up.
Okay. Helping to smooth out those bumps along the way.
So it's don't put all your eggs in one basket.
Exactly.
And make sure that, if one area is down, something else is up.
And this is where having that clear investment thesis for each holding in your portfolio is so important. If you understand why you own a particular stock or bond,
right,
you're less likely to panic and sell when the market takes a dip.
So again, it goes back to, knowing what you own and why you own it.
Exactly.
It's not just oh, I heard this tip. Make sure that you know why you are where you are.
Right. It's about having conviction in your investments, even when things get a little shaky.
Okay. So say, somebody is feeling anxious or uncertain, what should they do?
Well, don't hesitate to reach out to a financial advisor. They can provide an objective perspective
Mhm.
and help you stay grounded in your long-term goals.
Well, it's almost like having, a coach in your corner
Yeah.
to make sure that you're not making decisions based on emotions. Exactly. Because investing is a marathon, not a sprint.
Yeah.
There will be ups and downs along the way.
Yeah.
But if you have a solid plan and you stick to it,
Right.
you'll be well positioned to achieve your financial goals.
So as we wrap up, this deep dive, I just want to kind of leave our listeners with one thought to ponder.
Okay.
We talked about a lot of practical things today, reviewing your portfolio, managing allocation saving consistently.
Right.
But what's that one thing that you really hope our listeners take away from this conversation?
I think the most important thing is to remember that you have more control over your financial future than you might realize.
Okay.
It's about making informed decisions,
Right.
being disciplined with your savings, and staying focused on those long-term goals.
Yeah.
Investing doesn't have to be complicated or intimidating.
Yeah.
With a little knowledge and effort, anyone can build a brighter financial future.
Yeah, I think sometimes it can feel really overwhelming, when you start thinking about all these different things. But it doesn't have to be.
It doesn't have to be, take it one step at a time.
Right.
And, educate yourself and you'll be well on your way.
Awesome. Well, thank you so much for joining us and sharing your expertise today.
Well, thank you for having me.
And to all of our listeners out there, if you ever have any questions about investing, we're always here to help you navigate, the world of investing. And until next time, happy investing.